Good afternoon and good morning. Welcome to Treasury Strategy's 15th quarterly cash briefing and our second for 2015 for the UK, Eurozone, and North America. I'm Moni Lindsay, Managing Director in Treasury Strategy's London office, and I'm joined on this call by Tony Carfang, Partner of Treasury Strategies. We are pleased today to be joined by our panel, Peter Matza from the Association of Corporate Treasurers, Michael Berkowitz from Citi, Susan Hill from Federated Investors, and Alistair Sewell from Fitch Ratings. We're having a few technical difficulties, so we're not certain Alistair will be able to join, but we hope so. We'll provide further background on our panelists before the panel discussion. We're excited about today's briefing. As in the past, we will share with you the latest reports from the central banks on corporate deposit levels and central bank reserve balances. We will revisit and update our discussion from several briefings ago regarding the implications for corporates of Basel III. Also, we'll be discussing key game changers with our panelists to hear their views on the implications for you and for the market. A preview of what's ahead during that discussion. We'll be talking about the European money market fund regulations, money market fund variations and alternatives, banks trimming deposits and lines of business, diverging central bank policies and exchange rate volatility, taxing excess corporate cash, and operationalizing ring fencing. So a rich and timely set of game changers to discuss. Also, as a quick preview for the agenda, Tony will share with you the latest reported cash levels. I will then discuss the impact of Basel III on corporates. Tony will review game changers and facilitate the panel discussion, and I will wrap up. Please type your questions into the question box in the bottom right corner of your screen, either during or at the end of the webinar. We will take time to thoughtfully and thoroughly respond to your questions, and we'll be getting back to you with our written response in the next few days. We'll circulate the answers to all who have called in. Now let's get started with corporate cash levels. Tony, what are the latest reports from the central banks telling us?
Well, thank you, Moni. I'll tell you, it's been a very busy quarter, and not only have the central banks been busy, but our corporate treasury clients have been very busy reacting to all of the central bank activity, and our bank clients and money fund clients are adapting to regulations that are now becoming a lot more clear. With each passing quarter, we're getting a little more clarity about how these regulations are coming out and impacting financial institutions as well as corporate treasurers. I think as evidence that these issues are really important to our corporate treasury clients. We have over 800 people registered today from 47 different countries. So obviously the diverging central bank policies and regulations are having an impact. As you can see on the graph here, as we plot our corporate cash across 4 different jurisdictions, the cash in the U.S. continues to increase. And in fact, quarter over quarter, in this past quarter, cash has increased another 5%. You can see the trend line going back to actually the beginning of the millennium, and it's almost a straight line. Corporate cash continues to increase in the U.S. U.S. corporate treasurers are holding more and more cash for a variety of reasons that we'll explore during the course of the panel. I think the primary one, as we talk to our own clients, is the uncertainty of the impact of regulation and the uncertainty of monetary policies, which impact, exchange rates, currency movements, interest rates, shape of the yield curve. All of these question marks simply give corporate treasurers pause, and as a result, leave some stranded cash on corporate balance sheets. Moving to the right, in the UK, we see a very similar trend line, and in the past quarter, cash in the UK continued to increase. We can see from the beginning of the millennium, we've gone from 250 billion pounds up to 570, more than doubling over the period. In the bottom left, though, it's kind of interesting. Things seem to flatten in the Eurozone. or increase at a very slow rate over the last several years, and only in the last couple quarters have we seen an uptick. Now, we're not certain that this is a trend. If you look at the legend, the Eurozone is very slow in reporting these numbers, so unfortunately they are 9 months off cycle from the other numbers that you see on the page. And then, of course, on the bottom right, what we see here is Japanese corporate cash relatively flat over the last decade, but then accelerating, beginning at the end of the financial crisis and reaching 243 trillion yen. I was about to say a quarter of a blank, but I didn't know what the blank was. Whatever comes after trillion, we got a quarter of whatever that is. Looking at these numbers as a percent of the regional gross domestic product, we see in the U.S. Corporate cash is now 11% of GDP. That's actually been flat in the last year or so, and up from 9% at the beginning, in the year 2000. And of the regions that we're looking at here, this is actually the lowest slope, the lowest increase. When we look at the Eurozone, the UK, and Japan, we're seeing increases in the range of 40 to 50% as a percentage of GDP. The Eurozone up 50% from 14 to 21. The UK, up, about 30 to 35% from 25 to 32, and Japan up 33% from 37 to 50. Now, as we look at what the central banks are up to, and those of you on the briefing, I'm sure most of you have seen this particular slide before, but as we looked at this for this quarter, a question emerged that led to another slide that we're going to follow this with. It's kind of fascinating. So we see in the U.S. total bank reserves at the Fed have fallen by a couple of $100 billion. Now, we know that the Fed's stimulus has ended, QE3 has ended, but we also know that the Fed is replacing maturing securities dollar for dollar, so you would not expect to see assets, reserves necessarily decrease, but rather flattened. As we looked into this, what we're finding is frankly, just a reclassification of what used to be called reserves. A very close examination of the Fed's balance sheet this past quarter shows a shift of some bank deposits from overnight into about a 3-week maturity bucket. And I guess that lets the Fed take it out of the reserve category and simply call it a time deposit. So while it looks like reserves have declined in the U.S., in fact, bank deposits at the Fed continue to increase. We're going to be drilling down into this more deeply in subsequent cash briefings. Moving over to the right, we see at the Bank of England, UK banking reserves have been relatively flat for the last couple of years, and we're not seeing any major change there. In the bottom left of the ECB, which continues to announce one stimulus program after another, the number is not budging. We're kind of flatlining at about 200 billion euro, and again, for those of you who have tuned into our prior quarterly briefings, the Treasury strategies hypothesis is that the European stimulus is simply being recycled in a giant arbitrage movement back onto the balance sheet of the U.S. Federal Reserve. Keep in mind the ECB's overnight rate is minus 20 basis points. The U.S. Fed's overnight rate is plus 25 basis points. So there's a 45 basis point arbitrage, and our sense is that as the ECB stimulates, money moves into European banks, which flows into their U.S. affiliates and onto the balance sheet of the Fed. Just kind of a major recycling there. We thought it'd be interesting to show the Swiss National Bank on the bottom right, and we can see that spike at the end of December, and perhaps that should have been traders' early warning signal that something was brewing, and as we all know, at the very beginning of January, the Swiss revalued their currency. Now, because we saw the action and the dip in reserves at the U.S. Fed, we decided to take a look at the total assets of these central banks to see if that offered any clue. And sure enough, at the U.S. Fed, assets continue to grow. So which kind of confirms our hypothesis that we simply have a reclassification here. Now, one interesting facet, so we see the U.S. reserves at a little over $2.5 trillion. We are still at a point where more than 50% of bank reserves on deposit at the U.S. Fed come from affiliates of non-U.S. banks. So fully half of the reserves funding the U.S. Fed's balance sheet comes from banks whose parent companies are headquartered outside the U.S. Moving over to the right, with the European Central Bank, we can see that not only did reserves peak in 2012 and then fall back substantially, but total assets of the bank followed the same pattern. So, which would kind of give weight to our hypothesis that assets are leaving the Eurozone in search of higher rates elsewhere. The bottom left, the Bank of England has been actually fairly stable in terms of total assets of the banks and total reserves on the balance sheet. The Bank of Japan, is adding substantial reserves, but the level of other assets, if you look at the distance between the blue line and the red line, has been almost constant for the last 8 years here. So there's part of the Bank of Japan's balance sheet that has been constant, but the part comprised of reserves has really lifted off lately. Now we're going to take one more view here. And this is central bank assets as a percent of that region's or that jurisdiction's GDP, and this will give us some sense of the degree to which the central banks changed their policies following the financial crisis. And and as we know, there's been an uneven recovery here, and there may be some correlation as we look across these charts. For example, you can see in the U.S. Total U.S. Federal Reserve assets increased from 6% of GDP in year-end 2007 all the way up to 26% of U.S. GDP today. So we have almost 4.5, 5-fold increase in the assets of the Fed relative to the size of the entire U.S. economy. Going across at the ECB, we've only gone from we started at 17% of GDP in 2007 and only moved up to 22, which is a factor of only 1.3. So the U.S. increases 5-fold relative to GDP. The European Central Bank only increases 1.3-fold relative to GDP, and that conceivably explains some of the differences in performance. Bank of England has almost tripled relative to GDP, and the Bank of Japan has more than doubled relative to GDP. In subsequent briefings, we're going to be looking at these last couple of charts in a little more detail. And again, the reason we're doing this is, our corporate treasury clients are concerned about the impact on markets, availability of credit, volatility of exchange rates, because the central banks, whose policies can turn overnight, the central banks are a much larger share of GDP than they've ever been before. Now I'm going to turn this back to Moni, and one of the ways that these statistics translate to the real economy and is being impacted is, of course, Basel III.
Thanks, Tony. So we actually discussed this 2 quarters ago. We talked about the liquidity coverage ratio plank of Basel III and impact to corporates. The discussion is even more relevant today as we draw closer to Basel III. The key message is the same, and that's that this could be the single most impactful regulation for corporate treasurers in the post-crisis era. So the 2 key points here we want to make. The first is that the LCR was put in place to ensure that banks have sufficient funding to withstand a crisis. The second, and the one that impacts you the most, it requires banks to reclassify corporate deposits into 2 categories, as I'm sure most of you are aware. So we have the operational deposits, which are used daily in cash management and payments operations, and the banks can use these deposits to make loans, leases, and conduct other general banking activities. Now, non-operational deposits, which are any deposits in excess of your daily needs, or interest-sensitive deposits, not subject to 30-day withdrawal limitations. Banks can no longer use these deposits in their general banking operations. They have to invest them in high-quality liquid assets. And since the return on these assets is low, these deposits really have very little value to a bank. Now, the LCR significantly alters the way the economics of banking relationships, both from your perspective and your bank's perspective, the way the relationships operate. Banks generally will and are looking for operating balances and discouraging non-operating balances. So they'll want you to put them in 30-day or longer time deposits or else find another home for them. We expect to see changes in service pricing as well as new service products and rate structures. The attractiveness of your deposits will depend on the volatility of your cash flow, so banks are looking for stable operating balances, your ability to accurately forecast your deposits to know which can be placed in longer-term deposits to minimize volatility. The mix and amount of services you buy from your bank, with operating services generating operating deposits preferable. The nature of the business activity which underpins your transactions, so commercial transactions versus financial transactions are preferable, and then legal arrangements surrounding your accounts, such as escrow accounts. Now, if we go to the next slide, so what's changed in the last 6 months? The message and issues are really the same. It's just that they're just getting louder and clearer and more urgent. We've noticed a difference with our corporate clients. While a year ago they were aware, but concerns about the impact were not top of mind. Now they are top of mind. They want to know what is the impact of Basel III and money market fund reform, and what are the options, or what are your options. We see a change with our banking clients as well. They figured out the mechanics of Basel III and are well down the path of implementing processes and reporting to ensure Basel III compliance. But the banks are at a critical juncture. How do Basel III requirements impact their clients, their strategies, and their underlying value of their business? In our ongoing Basel III work with our banking clients, we see the critical questions banks are asking themselves as they develop their Basel III products and client relationship strategies, distilled into 4 clear questions. 1, do I have the right clients given the post-Basel III economics of my business? So if I do have the right clients, how do I defend them and keep others from poaching them? How do I attract new profitable clients? And what segments do I enter and what segments do I exit? How can I identify vulnerable customers and protect them from leaving? So these are the customers, from a bank's perspective, they want to keep, the ones that are generating the operational deposits. So which customers and wallets will be coming under attack, and how can they keep them? 3, how do I make clients more attractive, profitable to the bank? Do I have the appropriate share of wallet? And am I pricing clients appropriately given their post-Basel III profile? As corporates, it's important to understand your bank's answers to these questions to determine the impact to your banking relationships and the degree to which you will need to redesign your operational banking structure or reallocate. So Tony's now going to briefly review the game changers we see potentially impacting cash levels and management practices before we turn to our panel.
Thank you, Moni. And we have 5 game changers, 5 issues that we see this quarter that conceivably have a significant impact on corporate treasury and decisions that corporate treasurers have to make. The first is around operationalizing ring fencing. Ring fencing, protecting bank deposits will have a significant impact on which banks corporations might want to select to do specific types of business. Then we're going to move on to the EU money market fund regulations, which conceivably could reach a vote in the European Parliament, or at least a debate at the end of this month. And we're also going to discuss variations in alternatives that are being developed to money market funds. Next slide. We're going to look at the bank's trimming of deposits. You've seen a lot of headlines there. We're going to look at diverging central bank policies, and we're going to look at taxing of excess corporate cash. So, Moni, why don't you introduce our panel here, and then I will set up a few questions.
Okay, great, Tony. So we have a very distinguished panel, and we're excited. We have Peter Matza, who is Engagement Director at the Association of Corporate Treasurers, responsible for developing strategy to widen the ACT's engagements with the global Treasury community, as well as managing the publications business of the ACT. The ACT is a professional Treasury organization headquartered in the UK, but with members globally and delivering international qualifications globally. Michael Berkowitz is a Managing Director with Citi Treasury and Trade Solutions, where he is Head of North America, Liquidity, and Corporate Market Management. In this role, he and his team focus on providing Treasury solutions and short-term investment strategies to corporations, financial institutions, and public sector entities. In addition, he focuses on management of Citibank North America's balance sheet to ensure appropriate returns to the business and compliance with all regulatory requirements. Susan Hill is Senior Vice President and the Senior Portfolio Manager at Federated Investors, a leading investment management firm and pioneer in money market and fixed income funds. Sue is responsible for portfolio management and research of government money market funds. Alistair Sewell is a Senior Director and Regional Head of Fitch Ratings Fund and Asset Manager Group for EMEA and APAC. He is responsible for all the fund and asset manager research and ratings in those regions. So, Tony, what questions do we have for our panel?
Well, I'd like to start with Peter Matza from the ACT and ask about the question of ring fencing. We know that the British banks are well down the road to defining what ring fencing, how that might operationalize. So, Peter, why don't you share with us some of your thoughts and some of the concerns the corporate treasurers have regarding this?
Thank you, Tony. Thank you, Moni, and good day, everyone. You've touched upon one or two issues already in your talk about what's happening at the central banks, and in Moni's case about what's happening through Basel III. Clearly, this is another impact of financial services regulation on corporate activity. Without getting too parochial, I think our concerns here are really the idea that banks can be conveniently broken down so that, if you like, retail can be separated from what's considered to be wholesale or investment banking, isn't necessarily something that works for those of us as corporates and as treasurers in the real economy. It doesn't answer questions, for example, about the types of services that are going to be offered, whether for large corporates or small ones, in relation to things like trade finance, for example, export finance, for example, and straightforward corporate hedging activity, for example, nor indeed in some of the more active areas of the capital markets in terms of equity issuance, debt, and loan management as well. So I think our concerns are really that regulators have looked and said, we think it's, quote, risky business that in some aspects of what banks do, so we're going to try and split that up. One of the unintended consequences of that, and it knocks on into the idea of the deposit issue that Moni was talking about, is in some cases it may well be more sensible for corporates to be outside of a ring fence than inside, because there are also issues with bail-in provisions, which effectively turn corporate depositors on inside ring-fenced banks into effective equity holders, but equity holders without a stake and without a vote, because if they go down, your money is going to go down with them and you have no protection. That may be true in many jurisdictions today, but at least you have some choice as to where you're working with banks. In domestic terms, you may not, in particular in things like payroll and domestic payments and the like. So we have some considerable concerns that regulators haven't really necessarily thought this one completely through. We have had to accept it, but we have also been talking to regulators in the UK and in Europe, where there have been some proposals through Liquidity in respect of some of those activities, whether they're inside or outside, and the impacts on corporates. Of course, large corporates have choices. They can take their banking business to completely different other jurisdictions. In Asia, for example, where some or many or none of these restrictions actually may apply. So we have some issues. We've communicated that through our own activity, through the activity in the European Association of Corporate Treasurers, the umbrella group for European Corporate Treasury Associations, to regulators in the UK and Europe. But those are some of the areas in which we remain uncomfortable with some of the impacts about what's going to happen here. Unfortunately, we may not be getting quite the outcome that we would prefer as the real economy.
Thank you, Peter. And it sounds like your use of the word uncomfortable really understates your level of concern there. Let's move to Michael with a follow-up on the ring fencing, because I know this is something that you pay attention to day in and day out.
Sure. Thanks, Tony. I would just add on this that we're currently seeing several ring fencing efforts by national banking regulators. Another example of a ring fencing effort by the U.S. regulators is the Fed's resolution planning exercise, where they're seeking to ensure that banking entities are self-sufficient in each of their significant geographies and business lines. One unintended consequence of this, however, is that whereas previously most banks treated dollar deposits fungibly across the globe, you may now start to see differentiation in terms of banks' willingness to take deposits in different jurisdictions, and as a result, different rates offered in each of those different countries.
Fascinating. So it's not just a UK problem. This is an issue that we need to concern ourselves with worldwide. Let's turn to Susan. At Federated, you're investing in the commercial paper of these banks. What do these balance sheet contortions, how does that impact your investing activity?
Sure. Well, something we're watching very closely, Tony, from our perspective, from a credit perspective, in that I think there's not quite enough clarity from our standpoint to come out firmly on where we stand once everything is in place. We do sort of welcome some of the steps that have been taken, though, to sort of make, I think steps towards more orderly liquidations and steps that allow our credit analysts to more clearly understand the differentiation between the products that we evaluate, whether we're looking at a deposit or whether we're looking at commercial paper or others. And I think in the new world, we won't view those with the same mindset that we have up to now.
Thank you. Alistair, were you able to make the connection? It doesn't sound like Alistair's on the line. Yeah, there have been a couple questions about what is ring fencing, and if we happen to find it clearly, it's a term that requires a bank to basically segregate businesses from each other so that regulators can basically regulate and monitor and conceivably unwind each business separately.
Tony, can I add a small appendix to that? In some contexts, it's been defined as separating, quote, risky activity, generally associated, if you like, with prop trading or investment banking, from, quote, less risky or even what's considered to be non-risky activity, as in domestic and retail business. It's instructive to note in that context, however, that in the UK, certainly, over the last 300 years, the majority of our financial crises have been caused by property lending, whether that's commercial or residential lending going wrong. And in this particular context, that would all be, almost all of it, would be within the ring fence. So I'm not sure we're necessarily learning all the lessons of history, but perhaps that's not for me to say.
Well, and maybe if I can take that one step further for our audience to show the severity or the magnitude of the consequences here. In theory, if you are a depositor of a ring-fenced part of a bank and that part of the bank fails, you are bailed in as opposed to bailed out, which means part of your deposit is converted to either long-term debt or equity in that ring-fenced institution. So yeah, it kind of pales or the magnitude here is really severe if you happen to get trapped inside of a failed ring-fenced institution. And it's highly unlikely that any sovereign entity would bail out the ring-fenced part of an institution. They're basically saying, this is the riskiest part of the institution, you're on your own. Let's move over to money market funds. You know, at the end of the month, the European Parliament is scheduled to take up debate on a proposal that has a number of interesting twists and turns to it. Alistair, did you happen to make the connection yet? All right, let's go to Sue Hill then. And Sue, two questions here. Can you share with us the status of the European money fund regulations, and also share with us what you see developing as possible alternatives to money market funds should some corporate treasurers find the new regulations unattractive?
Sure, I'd be happy to, Tony. Let me just touch quickly on sort of what Econ voted on and that we potentially could see additional clarity on at the end of April. Three very quick things. Effectively, an exemption to a floating NAV for public debt funds. There is some outstanding question as to whether U.S. dollar-denominated sovereigns, for example, fall into that category, but there is, regardless, an exemption for those public debt funds from any floating NAV requirements. There's also an exemption for retail funds, which we find a little less helpful than we've seen in the United States because of the smaller proportion of retail, assets or investors in the European money fund universe. And there's also the proposal for low volatility net asset value products, where securities with maturities of 90 days or less within these types of funds, these low volatility funds, to continue to be valued at amortized cost, leading to a portfolio that could be more stable on a relative basis than what a fluctuating net asset value product would be expected to be. So those are the three that we see. We think it's a long road ahead. We may be the second step in a potentially four-step process. And if we use the United States as a guide, we're obviously in the final stage in the United States, but looking forward to see how the process will work. And turning to your second question, as more clarity comes forth about the various options ahead of us and the rules in final form, we'd expect without question for alternative products to develop. And because that's, our goal, I think, is to provide to investors the same stability of principal and liquidity that they're used to today. And so you'll see, I think, in the financial community a move to develop alternative investment types that might come closer to matching the nature of the products that we have today. An example of that would be, as we see in the United States, the development of money market portfolios that may invest only in 60-day securities in maturity or less, or 7-day securities in maturity or less. We may see in European money market funds, fund reform funds develop that would invest only in 90-day securities or less as a match to that. We'd also expect to develop or to discuss the concept of separate accounts, moving entirely outside of a money fund, the European money fund world, and also more private funds that would be less regulated but a little more flexible in terms of providing solutions to investors. So let me stop there and see if you have further questions.
So it sounds like there will be a range of options for corporate treasurers. We just don't know precisely what they are yet, but firms like Federated and all financial institutions are taking a look at this. Michael, could you take a second and share with us? You oversee your large corporate customers' liquidity, which I imagine includes money market funds. What are you hearing or seeing?
Sure, absolutely. And we do, while we don't operate our own money market funds, we do distribute money market funds from Federated and other fund managers. And so a couple of observations that we're seeing, and I'll focus particularly in the U.S. We did recently complete a money market fund survey and found that of the $930 billion that's currently in institutional prime funds, the expectation is that about 200 to 400 billion of that would be expected to leave as a result of the new U.S. 2A7 rules. And I think the view is that much of that would be expected to go into either government funds or other financial instruments. Some of it may work its way into bank deposits. And we've certainly seen in the U.S. some of the fund managers begin to change their lineup of funds to become more heavily weighted toward government funds. One of the other things that we saw, though, in the survey, though, is that in the current interest rate environment, there's very little cost to go from a prime to a government fund. The yields aren't all that much different. But as rates rise, we would expect to see a greater willingness amongst investors, either to potentially go back into a floating NAV prime fund or some of the other alternatives that Sue discussed, shorter-term funds, separately managed accounts, private placements, even ultra-short bond funds to help receive some yield enhancement.
Interesting.
So, hi, this is Alistair Sewell. I think I finally managed to make it, if you can hear me.
Oh, welcome.
Thank you. I apologize.
Why don't you? We're talking about money market funds, and could you share with us what you see as the next steps in the European Union's consideration?
Sure. Well, I just picked up on the last of Susan's comments on the money fund regulation in Europe. But I guess there's a couple of points I would add to that, which I think are quite interesting and quite, in fact, pressing, potentially quite pressing for end users of money market funds. So the first of those is that the date for the vote is coming. It's scheduled for the 28th of April. We have seen delays in the past, but nonetheless, there is a date, which is the 28th of April, which is not long. But perhaps what's worth looking at is the implementation period. Now, in the current proposal, the implementation period is 9 months. So relative to the approximately 2-year implementation process for money fund reform in the US, the pace of change or the expectation from the regulatory community in Europe for the adoption of these new standards, these new rules, is very rapid indeed. And certainly users, providers, and service providers to the money fund community will need to adapt very quickly. I think perhaps you throw in the context of potentially negative rates in Europe as well, and you have a heady mix of change coming in short order to the corporate treasury community.
Great, thank you. Now, Peter, this obviously is an issue that I know is near and dear to your heart. Why don't you share a few thoughts?
We have a couple of other things. Interested to hear Susan's suggestions about some of the potential new funds or products that might be available. But I think the two considerations I would raise here are perhaps cut across all of those, and Alistair sort of alluded to one of them there. One of the other main issues that we have is not any of this change, it's something we haven't mentioned, is the potential that ratings might be taken away from money market funds. If ratings are taken off money market funds, whatever the product looks like, whatever they're investing in, the vast majority of corporate treasurers certainly in our experience would not say that they're going to carry on investing in those products. Full stop. They're just not going to go to their boards and say, give me authority to invest in something that I don't have a time to do the credit due diligence on, and by the way, the rating agencies aren't allowed to do it either. Not going to happen. Full stop. End of story. Even if you told me that the funds were only investing in bunds, I don't have the time to spend all day worrying about that. And I'm sure boards don't want me to spend all day worrying about that. So I think that's a really, really big issue that has to be addressed and is still out there. I think the other point is...
Peter, sorry, so Alistair here, but just to provide a little reassurance on that, and I suppose I would as a representative of a rating agency.
Hopefully.
In the latest version, the draft report from the Econ Committee, the potential ban on ratings was dropped. And instead, rating agencies are now required to rate money funds in accordance with, I believe, CRD4, which is the overarching regulation of money funds. That said, the final vote is still to come.
Yeah, and from what we've heard, we're not sure that the rapporteur is that keen on it in terms of it being dropped at all, and there are people in the Parliament that are not keen on it either. This is politically motivated, in my personal opinion, and is not any reflection on the capability or the need for ratings to be doing it. On the contrary, we are all in favour of it, absolutely. So your reassurance hopefully will bear fruit, Alistair. I think the other point I was going to say is the time consideration is just unreasonable, full stop. Regulators, once again, I think have thought that this is an institutional industry and not one necessarily involving corporate end users who also take time to adapt to these things as well, in terms of going to boards and all that sort of stuff too. So we have a practical concern with it as well as that overarching concern. If the ratings one is taken off the table and stays off the table, then to that extent we're back to where we were with all the other issues that we had. But hopefully that one therefore might get resolved in our favour.
So there's a lot coming down in the next couple months that will have a serious impact. So, encourage everyone to stay tuned. I want to move to the next point and direct the question to Michael Berkowitz from Citi. We see headlines of banks asking corporates to take their deposits elsewhere. We see headlines of at least one bank charging for deposits, and we see stories of banks, trimming lines of business, either entire lines of business or geographies. Could you share with us what's driving that, and what does a corporate treasurer need to know about this?
Sure. Thanks, Tony. And I'll provide a little bit of background on that, in addition to some of the comments that Moni had earlier. So a lot of it is a result of Basel III, which is requiring banks, and particularly the global systemically important banks, or the GSIBs, to hold significantly higher levels of capital and liquidity. And that, of course, comes at a cost, and that's resulting in some of the changes that we're seeing. One particular area that you've mentioned and that Moni talked about earlier, where banks are adjusting strategies in response to Basel III, is with respect to deposit taking. And so it's really a result of the combination of the liquidity coverage ratio, the LCR, which is already live in the U.S. for banks with assets of greater than $250 billion, but also the supplementary leverage ratio, which requires banks to hold capital against those incremental high-quality liquid assets, which Moni talked about. And so as a result of that, holding short-term balances from particular types of short-term balances, including those from hedge funds or non-operating balances from other financial institutions, in particular, become increasingly costly for banks. Non-operating balances from corporate clients are more costly than they were before, but not nearly as much so as non-operating balances from financial institutions. So what I would say overall is that I think for most corporate clients, the situation is not as dire as it sometimes sounds. And I would say that, at Citi, our commitment to our corporate and our financial institution clients has never been stronger. As Moni said, operating business and operating deposits will remain highly valued. And banks such as Citi have rolled out some new structures for excess balances, such as higher yielding 31-plus day structures. Ours is called a 31-plus day minimum maturity time deposit. And then for excess balances that can't be placed into those types of structures, off-balance sheet instruments such as money market funds or some of the other instruments that we talked about earlier can represent good liquid options for those excess balances. So, I think echoing the comments that Moni made, the key is really to speak with your banks and your investment providers to choose the vehicles that are the best fit for your needs, and there do remain a number of options for short-term liquidity management.
Great. Thank you, Michael. Now, Sue, as an investor in bank deposits and bank commercial paper, how do you look at these changes? And when you hear announcements about a bank selling a line of business or a bank shedding certain deposits or assets for that matter, as an investor, what goes through your mind?
Sure, Tony. Actually, I'll take this two ways, if you don't mind, since I have the floor. One being, again, from a credit perspective, as we look at the entities and view the announcements that are being made, I mean, I think what's really obvious from large financial institutions, across the world, really, in the face of regulation, is each one is looking very closely at their lines of business and shedding those that are no longer profitable as a result of either current or soon-to-be implemented regulations. From a credit standpoint, that has to be a positive from our view. We do see a wide range of responses from the entities that we deal with on a daily basis from an investment perspective as to what is driving their decision process. It's not a clean process by any stretch of the imagination. I think every day there's something a little bit different as banks are struggling internally to come to grips with it. But at the end of the day, again, it's positive from the financial standing of the institution. It's a little bit challenging from, from an investment management perspective. I do want to echo what's been said a few times to stress the importance of understanding the relationships that you have, with your financial institution. I'm struck by the parallel between what you as corporations are facing today and what we as investment managers have been facing with our dealer community for the past few years. And what's benefited us is to spend the time to do just what we've said, understand how important we are to each dealer, where our lines of business are that are most valuable to them, how we can adjust the business that we do with them on a daily basis, can they offer us different types of products that meet our mutual needs, or if there's something that we just can't or just is not valuable enough to that individual counterparty, where else can we go from an investment perspective to meet our needs. It's very similar to the process that I think you're faced with today, and I think it's just important to understand where you stand with, with the institution that you deal with.
Thanks, Sue. I'd like to address a follow-up to Alistair. You rate money market funds at Fitch Ratings. Do you look through to the underlying, let's say, banks or the short-term instruments that are held by the funds as part of your rating? And if so, how does this bank repositioning impact the way you might look at a rating?
Yes, absolutely, Tony. Thank you. We do look through to the holdings of a portfolio in assigning a money market fund rating. We look at risk across three dimensions. We look at the credit risk embedded in the portfolio, the level of market risk embedded in the portfolio, and the level of liquidity risk embedded in the portfolio. And I should also just make a point as well that we fundamentally rate to risk, and that's what's front and center of our mind when rating funds. What I mean by that is that we don't rate on the basis of currency, and we don't necessarily rate on the basis of the prevailing rate environment. So in our mind, the fact that a money market fund operating in a prevailingly negative yielding environment posts a negative yield is not necessarily a rating negative event in and of itself. And I think that's quite an important point to make. In terms of the credit quality of money market funds, we have seen that credit quality has come down slightly over time, but recently it's begun to stabilize and in certain cases to improve a little bit. And I think that's because fundamentally we are seeing two conflicting trends, if you like, in the banks which form the vast majority of the money fund portfolios. On the one hand, we are seeing a weakening of sovereign support for banks, which is a rating negative. But on the other hand, we are seeing capital strengthening in many cases. So banks are building up regulatory capital or building up equity buffers as a result of becoming sounder entities. And additionally, we see this ring fencing, which may lead to some banks potentially having a rating differential. Of course, I would need to defer to my colleagues in the banking team on that. But we do see these two trends, the gradual removal of sovereign support, which we are reflecting in our ratings, and on the other hand, the intrinsic strengthening of certain banks in their own rights.
Thank you. Now, Peter, it's your members are the ones who are impacted by banks reallocating or shifting their priorities around deposits and lines of business. Do you have a final thought for us on this topic?
Yeah, very briefly. I'm less concerned with the specifics, perhaps from an investment point of view, or the deposits more particularly. But the simple reality is that the global bank model, the all things to all men model, well, that's dead. The idea that you can go anywhere with the same bank is dead. And in particular, a lot of the other regulatory issues in terms of things like compliance and AML and KYC and all those sorts of things are driving banks out of marketplaces, either geographies or particular business lines for other reasons completely unrelated, if you like, to the Basel III ones that Moni talked about earlier on, but in relation to all sorts of other things. The simple fact is, and I take Michael's point, corporate treasurers, it's now necessary for them to make sure they sit down with their banks and say, where are you doing business? What business are you doing? This is what we need to do. How does that map across? Are there other people that you can help us work with? Or where else do we need to go to get the help we need to get our business done? And I think those are the simple lessons for corporate treasurers over and above, if you like, any of the detail here on the technicalities of the regulatory impact.
Well, I think what we're hearing this morning across the board is that there are some major changes brewing on the horizon as a result of banks and funds implementing regulations that are already in place, and that there still are regulations being drawn. There are two other game changers we had on our original thought, on our original slide. In the interest of time, we're not going to deal with them, except to say that one was taxing of excess corporate cash. We'll deal with this the next time. However, in South Korea, there is a regulation now that begins taxing excess corporate cash. We'll explore at some future date the implications of that. We haven't seen that concept spread, although there are conversations in Japan about this, and as you all know, bad ideas can spread in this environment pretty quickly. So we'll be watching out for you on that. Let me turn this back to Moni to conclude, and look forward to seeing you again next quarter.
Thanks, Tony. Great panel. So we thank everyone on our panel. Thank everyone for joining, and to our panelists, Susan, Peter, Michael, and Alistair. Look for our invitation for the briefing next quarter, and also for corporates on the line, we will be doing another survey for the next quarterly briefing, so please fill it out. It's important for us to have a good understanding of what's going on and the trends that are impacting cash levels. Thank you, too, for your questions. We'll answer and circulate to all who registered, and we'll also send you a copy of the report. And we encourage you to look at our sponsors' websites and our website for further articles and commentary, and to reach out to us if we can help you with your liquidity, forecasting, technology, or other needs. Thank you.